Howdy, Jacob here. Today we're looking at Amdocs in the IT services industry. 9.8 billion market cap, 9.9 billion enterprise value. So a little bit of net debt. Return on invested capital averaging in that low double digits, so pretty impressive. Their growth is fair, not crazy impressive, but darn if it's not crazy consistent. Their lowest revenue growth year over year was 2%, and their greatest was 6.8%. So they're very consistent with their growth. They're very consistent with their gross margin, as low as 33.9%, as high as 35.5% in the last 10 years. And then their operating margin, also crazy consistent, 12.9% to 14.8%. So they're really consistent. I think that there is a premium that is deserving for companies that are very consistent. I mean, think about it. If I can give you with a 99% certainty $5 a year for the next $5 a month for the next 10 years, or I can give you probably 2.5 to 7.5 with that average being 5. I mean, which one are you going to take? I mean, it's so consistent. That's the riskier something is, the greater the return should be. And so when you have something that's very consistent, very smooth, it's going to be able to have a premium to it because people are going to be expecting something. There's a higher probability of something occurring. And return on invested capital has never been single digit in the last 10 years. Very impressive. Their income statement shows R&D as well. So not quite 10%, but you're looking at maybe 6 to 8% of revenue being spent on R&D. Take money away from today to hopefully make more in the future or be more efficient. Balance sheet has 742 million cash-like products, no short-term debt, 646 million long-term debt. So more cash on hand than cash-like products that on hand than their long-term and short-term debt. Their free cash flow capex has gone up a little bit, but cash from operations is up more. So greater production of free cash flow with majority of cash going to acquisitions, reinvestment, share repurchases, and then they do pay a dividend here of 2.2%. So on average, let's say they make 600 million. You got about a third going to dividends. You got maybe 40 to 50% going to share repurchases, with the remaining roughly 15% going to acquisitions and reinvestments. So I think that's enough for me to want to get to making some assumptions here. So on the revenue growth side, I'm probably comfortable with a 5%. I think that's pretty reasonable to me. 5% with growing, with inflation, a little bit of acquisitions here and reinvestment. And then I think for margins, I'm good with, what are we seeing this average to be? Okay, let's go 12 and 12. Easy peasy. And then for share change, 1% is about $100 million. So $400 million would be a good chunk, maybe 60% of free cash flow. Let's go down a little bit. Let's go $300 million would be about 2%. And that's going to be probably a little bit less than 50% of free cash flow. And then I'm giving them a pretty big premium here compared to what I usually do. And again, that's because they're very consistent, and consistent businesses get a premium. I mean, look at Coca-Cola, look at those retail consumer staple companies. They're just very consistent with their growth, both on the top and bottom line. And so they deserve a premium because, one, they have a moat, but if you take that out, it's less of a premium, but they still deserve a premium because they're growing pretty much with inflation. I mean, 2 to 5% a year, been around since like the late 1800s. It's very impressive. But here, with how consistent they've been in the past, I think I'm good with these assumptions. Dividend, have they increased that historically? They have. So let me just increase it 1%, because I don't like to increase it too much, because I want the company to have a lot more capital available to reinvest, make acquisitions, buy back shares at an advantageous price. And honestly, we're looking pretty decent here. So this could be an interesting business, 23% off where I'm looking for. I think when this gets a lot closer, this would definitely be something I'll take a priority in reviewing, since it's definitely an interesting company that's crazy consistent. So I hope you enjoy the video and have a great rest of your day.